In this video, we're going to be covering what a lot of traders really don't like to talk about. It is the proverbial leg day for the gym. Not a lot of people like to do it. It's something that makes people groan. They kind of think to themselves, well, this isn't really something that concerns me. I'm really only concerned with the perfect times to get in the market, the perfect times to get out of the market. And they go around thinking, if I have the best system in the world, it's not going to matter what I do here. So, I'm talking about, of course, money management. Now, I'm of a strong belief that money management is definitely the number one most important thing when trading currency. I know a lot of traders say this, but they don't really explain why, and they don't really get into the concept of how changing your lot sizes on your orders based on confidence and based on percentages of your account and things of that sort. They don't get into how this can actually ruin you as a trader and put you in the negative really quick with almost no way to get back out. So first, let's talk about a couple of myths that surround money management. Now, I think the number one myth that I see, and a whole lot of people are guilty of this. I've even met professional traders that are guilty of this to an extent, is focusing way too much on pip return and percentage win instead of dollar amount. Now, when talking about it on the surface, that seems crazy. I mean, you're not in the Forex game to make pips. You're in the Forex game to make money. The end result. The pips is just a way to show your win-loss ratio essentially. And a pip is worth something different based on different lot sizes. For example, if I were to open a new order and my volume is currently set at zero point 0.1, which is a mini lot. If I were to sell, then you'll see that because of spread I'm negative 2.3. So basically each pip is worth $1, right? But if I were to close this order, actually give me 1 second. If I were to make a new order, you know, and go at a standard lot, then I'm down $20 with the spread. Each pip is worth about $10. Now I know that's very basic, but really think about it logistically. If you were to enter a trade and you were to go up 200 pips at a mini lot, with a standard mini lot, then you would be up the exact same amount of pips per dollar. So if you went up 100 pips, then you would have $100 profit. And conversely, if you were to go down, then you would have, down 100 pips, you would have negative $100. Well, you can take a 15 pip trade at a standard lot and be 150 pips up or 150 pips down in the opposite direction. You need to position your lot sizes in a proportion based on your your profit target versus what you want to see out of the trade in a dollar amount. Focusing too hard on pips will it's basically a losing game, if you will. Nobody's going to be right 100% of the time, and even still, even if you're right, quite a few times, and your position sizing, you don't pay enough attention to your position sizing, then you actually have a chance of even being 60-70% accurate. You still stand the chance of being negative money because you're not positioning your lot sizes correctly. This is actually turning out to be a positive trade. That's fantastic. So really, when you think about it, the amount of pips that you gain is completely irrelevant. The amount of pips that you win or lose is completely irrelevant. What you're really looking forward to is the amount of money that you put in your pocket at the end of a trade. That's all you should really be concerned with because you're in this money or in this game to make money and not pips. So try not to focus on pips too much. If you position your lots just right, you don't necessarily need to get all that many pips in order to be profitable. Basically, you need to treat each trade like a business transaction. You don't necessarily need to be a game to see how many pips that you can get at a certain period of time or what have you. It should be beyond that. It's a business transaction. You should conduct it as such. This is money that you're potentially gaining or losing. So you need to think of your gains in terms of dollars and not necessarily how many pips you've made for the day or for the week or for the month or what have you. Alternatively, whenever you're placing your stops, you're not necessarily, you still need to think about it in terms of dollars. You're not necessarily risking, 150 pips, 200 pip stop. You're not risking any pips. What you're risking is dollars. So you need to factor in uh, your lot sizes whenever you're doing your accounting. Basically, you need to make sure that you're positioning your lot sizes in terms of dollars and not necessarily in terms of pip. Okay, taking that a step further, just kind of stressing the importance of money management here is one of my favorite little infographics of all time. It's kind of a really simple breakdown showing you if you lose X amount in your account, not talking about pips, we're talking about dollars here. If you lose a certain percentage of your equity, then the amount of return necessary to restore to original equity needs to be, if you're working with percentages of your account, it's an exponentially increasing thing. So let's say here, you've got $1,000 and you lose 25% of your $1,000, which sits you at $750 or $750. You need to make 33% of your account just to go back to break even at this point. So I mean, even taking that further, if you lose 50% of your account, you need to literally double your account to get it back to where it was before. And fun fact, a feat that's a feat accomplished by less than 1% of traders worldwide. Is just to be able to double your account on a whim, and that's just to get back to where you started. So money management is a very important aspect of trading. I mean, let's not forget that if you go 75% down or 90% down, I mean that's 400 and 1,000% respectively, just to get your head back above water. So, a very important thing, money management. Um, Another one of the things that I don't really like people talking about so much, they talk about this like it's the end all be all of money management rules, is you need to risk 1 or 2% on every trade, and it's a good way to grow your account. A lot of people say this because risking 1 to 2% is a very safe play. It's kind of allows you, if your account is growing, if you're actually winning these trades, that 1 to 2% gets bigger. You're actually beginning to risk more dollar wise, and which allows you to have a bigger return dollar wise, and it becomes an exponentially increasing curve. A lot of traders like the way that this looks. I mean, obviously, if you start with, $1,000 and you have an exponentially increasing curve using a standard simple percentage of your account, then, everybody's seen the curve. By the end of a year or 2 years, you'll have $1 million, and it's obviously a little bit unrealistic, for one simple fact, is people don't traditionally like to count losses in this. So as you start to lose money in your account, just say you start with $1,000, you start to lose money in your account using a 1 to 2%, um, 1 to 2% risk on your account, and say you lose 5 trades in a row. If you're risking 2% of your account, you're depending on how many pips you're actually risking, you're down say to about $4,500 or so. And say you're still risking that 2% per trade. Well, you're now risking a smaller amount of your account. Okay, you're no longer risking the 2% at $5,000. You're risking 2% at $4,500, which is obviously a smaller number. So quite literally, as you're losing money in your account, by sticking to that 1 to 2% adage, it takes longer for you to get your head to get back above water, as it were, um, and it becomes a much more difficult thing, just to get back to where you were before. So as you're losing money, that number shrinks, and you actually have to win more just to get back to where you were. So I generally, especially with smaller accounts, now bigger accounts it's a different story, but smaller accounts, which most traders deal in smaller accounts, especially when they're starting out. Um, I like to tell them that going for a set dollar amount per trade is a much better way of doing things. And I'll get into that just a little bit more here in a minute. It has to do with risk to reward ratios. A big myth, another big myth is a lot of people like to say that, again, touching a little bit more on the pip basis, putting more credence in how many pips you get as opposed to dollars. A lot of people naturally assume that a wider stop risks more money than smaller stops do. Well, this goes back to the original topic, is that say you've got, you're risking a certain amount of pips, say 50 pips. Naturally you would think in your head that, risking 150 pips is a much more dangerous thing to do because it's a bigger number. You're losing more pips. Well, what you do in this situation is you adjust your position size. You adjust your position size just like we did with this original trade here to the number of dollars you're willing to risk on the trade as opposed to pips. So you can actually factor out, say, I want to have a 50 pip stop loss. And in my mind, instead of saying 50 pips at a certain lot level, at a specific lot level, I'm only going to trade a micro or a mini at 50 pips or 100 pips or what have you. You should think to yourself, this is the amount of money that I want to risk on a specific trade. And then you take that information and you factor it out across those 50 pips. And here's how you do that. Say you know that you're trading an instrument just like this, the pound US dollar. So one standard lot is $10 per pip. Say, you're setting up your trade in such a way to where you see that you're using some sort of a nice resistance stop here, and it's about 45 pips or so. Say you want to risk, and instead of thinking about it in terms of pips, you want to risk $200 on this trade. You know, so what you would do to work that out is you got your $200, and then you divide it by the number of pips that you're willing to risk, basically your stop loss, which gives you $4.44, $4.45 per pip. And since we know that we've got one standard lot size is $10 a pip, so it stands to reason that uh, for mini lots, or 0.44, which is 44 micro lots, would be the position size to use. That way, if we were to come down and lose all of this, if we were to actually lose this trade, then we would know the exact dollar amount and we know that this is the amount that we would lose on a trade with the given number of pips. So let's say our stop is much wider than that. Let's say our stop is, about 120 pips instead. Well, we still want to risk the $200, but over that large pip area, 120 pips instead of the 45. So in that case, it would be the pips that we want to risk, which is 200, divided by the um, the number of pips that we're looking to use as our stop, and that gives us, $1.67 per pip, and that would work out to either one, if you want to round up, either one mini, or excuse me, two minis, or 1.7 micros, which I always suggest trying to get a broker that allows you to deal in two decimal places, which is micros. It allows you to have a finer point on your money management, and so you could, use smaller accounts much more efficiently. So in this case, we're still risking the exact same dollar amount, right? But we're able to position our stop loss in any way that we see fit. So whenever people tell you, that you've got too wide of stops, you're using 150, 200 pip stop, 500 pip stop, whatever you want. People telling you that's too wide, you're going to lose too much money. That's simply not true. You can actually, just with a little bit of math, a little bit of, uh, fundamental math here, you could actually extrapolate your dollar amount, which is the only thing we should be concerned with. You extrapolate your dollar amount that you're going to lose or stand to lose over your pips that you stand to risk in any given trade, and come out with a lot size that will gladly go come in line with this. So even still, you can pull your stops very close, right? Very close, and increase your lot size. Say for example, you're going to take a breakout trade, right? You want to take a breakout trade, and you know that if the market doesn't run in your direction uh, fairly quickly, or somewhat immediately, just kind of let you know that it's going to go in your direction. If you're going to cut your stops real quick, you could still risk that $200, but in a much tighter stop. You could actually do it over 15 pips or something and increase your lot size to closer to a standard lot. And in that case, if it does pop and it takes you down quite far, if you're looking to sell, if it does pop and it takes you down quite far, like in the breakout video, you only make, 50 or 60 pips, but the thing is you're risking that $200 that you were initially able to risk. And because your lot size is much bigger, you don't have to go for near as many pips in order to get with the number that you are happy with receiving. So don't let anybody tell you that more pips or less pips is good or bad. It should always be extrapolated by the dollar amount you're willing to lose. And the tighter your stops with that dollar amount, the more money you stand to gain. You know, but always put your stops in accordance with your system. Don't just tighten your stops to almost nothing with this huge lot amount, because you're going to get stopped out way more, and it's going to be very counterproductive. But always position your lot sizes based on your stop loss like that, and think in terms of dollar amounts and never in pips. Now, something really really cool that I like to preach a whole lot about is risk to reward ratios. Okay, so we've been over how to kind of take your stop losses, how to position them in such a way to where you only risk a certain dollar amount. Okay, and that's what we were talking about before. If you risking a percentage of your account and you stick to risking that certain percentage of your account, no matter your stop loss or your take profits or anything like that, then then if you begin to lose, your position sizes are going to get smaller and smaller. That's why I like to stick to a certain dollar amount. And if you position your win to loss ratios in a certain way, okay, so like this is, for example, it's about 40 pips or so. And say we go down to 120 pips or so, that would be indicative of breakout or a swing trade. It would be a really good uh, risk to reward on a swing trade, especially if you're, say, sitting at the top of a downtrend. This is just an example. But if you're, doing the swing trade like we were talking about, and you're in such a position to where everything is lining up, and you know that your stop loss is going to be pretty tight, because it's going to be obvious if the trade is not going to work out. It's going to go and it's going to break your level of resistance. The stochastics might fall out of line, and things just don't look like they're going to work out. You can cut your stop real quick. But generally, especially on longer term trades, let's say for example we had something like this going on, and we had our trend lines pointing down, then you would be looking to go to the other side of your trend lines. So your risk to reward would be pretty big. So in this situation, if you're always looking to do your swing trades or your breakout trades in such a way to where your risk to reward is about 3 to 1, well, and you're risking just a dollar amount instead of a percentage. Well, that's very good for you, because the percentage that you win can be much smaller than like a 1 to 1. Like, you don't have to win half the time or more in order to be profitable in this at all. As a matter of fact, you can go all the way down to being having a win rate of 35, 40 pit or 40%. and still be quite profitable. You can lose more than you win and still be quite profitable uh, by using this type of ratio. Set your trades up in such a way to where your stops are kind of cut off pretty quick. You have a set take profit. You know where you're going to exit the other side of the trend channel or something out of that effect. And by doing so, then you've given yourself the opportunity to be able to lose more than you win. Up to 3 times more than you win, depending on your actual ratio, and you'll still come out ahead. Dollar wise, you'll still come out ahead. Now, you might not have as many pips, but once again, who's counting? It's all about the dollar amount at the end of the day. Let's just take a quick example on this. Let's say you got an account of $5,000, right? And you're risking $200 per trade, as we were talking about before. On this sell, your stop loss is positioned in such a way, and your lot size is positioned in such a way to where you'll only lose $200. But let's say you have a 3-to-1 ratio. Every time you trade, you're looking for about a 3-to-1 ratio, risking a certain number, like 2-to-1. So let's say on your first trade you lose. So now you're sitting at $4,800. Okay. And say you lose your second trade, you're not doing so well this week or what have you. So you start with 4,800, and you lose another 200. So now you're sitting at 4,600. Bear with me on these dollar sign typings here. Okay, say you win your third trade and your fourth trade. Well, if you're doing a 3-to-1, then every time you win, you're winning 600 instead of 200. So if you win your third trade, and then you're plus 600, then that puts you at 5,200. Okay, and say you win your fourth trade, so you're at 5,200, and then you go 600, and then you're up at 5,800. So currently, you've lost twice and you've won twice, but because you are trading, either a swing trade or a breakout trade, something where you can actually move your stop closer, and you're risking a set dollar amount, not a percentage of your account, but a set dollar amount. You're able to win less than you lose and still come out quite a bit on top. So you were up $800 after losing twice and winning twice. And by losing first, it doesn't take down our percentage. If we were risking a certain percentage of our account, we would risk X amount of dollars here and then a smaller amount here, and then it would take us almost twice as many trades just to get back to 500. So as you can see, once you start to play around with these numbers a little bit and you realize that you can extrapolate the amount that you're willing to lose over your stop loss, or even the amount that you're willing to gain over your take profit, and you keep adhering to your risk to reward ratio, then it becomes easier to come out on top in that situation, especially with smaller accounts. Now, when it comes to actually setting stop losses and take profits, sometimes it's not possible because your take profit is based on something that moves on a per candle basis, like say the other side of a descending trend. Your stop losses, I almost always should be hard set. If you're willing to risk a certain amount of dollars, then you already know what your stop loss should be out of the gate. You should go ahead and set that at the very beginning. And at the very least, monitor your profits. If you're not going to set a set take profit, like a hard set take profit level, monitor them. And something I like to do is if you're really aiming for the other side of the trend channel, then what you can do is say our hard right edge is here, and we're in a sell, and you want your stop loss to be at this trend line, or your take profit, excuse me, to be at this trend line, then, I mean, this might be a bad example because it's an hour chart, but in a swing trading situation, it'd be a 4-hour or a daily chart or something like that. Then every 4 hours or every day, whenever a new candle's formed, just come back, find what the new level is, and set your take profit to that level. That way, if something happens and you're gone, you still have a set stop loss, take profit that adheres to your money management rules and your risk to reward ratio that you've got set up. So setting stop losses is a definite. Setting take profits when you can is a very good thing to do. Now, when it comes to moving stop losses, this is something else I'm also really big on. Uh, I really like what's called a free trade. Okay, I know sometimes this might be a little bit counterproductive because it could take you out early, but you try to think about it in terms of money. Okay, there's nothing better than a free trade. Because at the end of the day, there's nothing you can't really look at it and, oh, I could have gained $100,000 from this trade. You can't really think about it like that. If you do, you drive yourself crazy because there are going to be moves that you miss. There are going to be decisions that are made that are bad. But in my mind, in my opinion, a free trade is never a bad idea. Never. So if you get all sad about, I move my stop loss to break even, which is the main bullet point here is what I'm trying to say is once you get it to a certain amount and you're fairly confident that it'll continue in your direction or whatever your system is telling you, move to stop loss, cover your spread. And you move your stop loss, cover your spread. And you might even want to give yourself a pip or two depending on your lot size. If you've got a standard lot, you move it to break even, move your stop to your entry point, and then give yourself 3 or 4 additional pips. That's 30 or $40. That's guaranteed to go in your pocket that you wouldn't have either way. And some people might be saying, well, you could just leave the trade open. There's a chance that it'll come back and hit your stop loss at your entry point, take you out of the trade, then turn right back around and go down and make you a gazillionaire. Well, yes, that's true. But the thing is, as soon as you move your stop loss to break even, that's a free trade. And break even plus 1 or 2 pips, that's extra money in your pocket that's completely free. I'm able to breathe a whole lot easier, especially during swing trading, knowing that there's no way that I could lose money on that trade. As long as the world continues to spin, that will continue to be true. Um, by moving your stop loss to at least break even once you get to a certain amount of dollar profit, then I mean, I'll take a free trade any day. If it continues down to my take profit, then good. That's wonderful. If it hits my stop loss, which is at my entry point, then it's nothing out of my pocket, no skin off my teeth, and it even gave me a free trading opportunity to further test my system, if you will. So I'm really big on moving stop losses pretty quick, not super quick to where it takes you out every time, but if you're, if our trade goes about halfway down this, there's no reason that you shouldn't move your stop to at least break even. I mean, it's really is the best thing to do, especially with smaller accounts. If you're worried about your dollar amount or what have you, moving your stop to break even is just a wonderful way to protect your profit. Okay, and one of the last things I'm going to touch on here is kind of in the same boat. It's what I call scaling out. I mentioned it in one of the previous videos. And basically what this means is I wish this trade was still in profit so I can kind of explain it a little bit. But, if you put on a trade, go ahead and get rid of all this. If you put on a trade and your trade goes, you're moving your stop to break even and your trade goes down into like the middle of the channel like this. Um, if you don't want to get out of your trade completely, if you still have, if everything's still pointing okay that you're going to reach your ultimate take profit down here, there's no reason why you can't scale at least a little bit off of this trade. And what I mean by that is what you can do is you can actually right click it and go to close order and you can actually specify how much you want to close. Okay, so if you're in a standard lot and you're dealing with micro lots here, uh, you can actually close a very small amount of your uh, a small amount of your trade, which puts, if you're in profit, it puts money in your pocket. I mean, you don't necessarily technically have to move your stop at that point. You've already pocketed some money. I still definitely recommend moving your stop to break even at least though, but it allows you to pocket some money as the trade is going along, just in case it does turn back around and take you out. You see, you have to really think about all of this in terms of dollars. So, so now that my trades come in profit, I'm a good $17 in profit. I can actually say, well, I want to pocket $10 of this, right? So I can close half of that trade, and I just pocketed, a pretty fair amount of money, and the trade is still in profit. So I'm able to pocket money as it's going along by scaling out of my order. Now, I know you won't get as much money doing this as if you came down and hit your take profit, but it's all about risk management and mitigation. You want to be able to um, always think about it in terms of dollars and always uh, not take everything at face value. You can scale out of your orders. I don't really recommend adding to your position, but you can scale out of your orders. You can uh, I already took some profit on this, and I can go ahead and close the rest of it now. And so I ended up, I think that was like 10, and then I had another 15 or so. That's $25 in my pocket, completely done and free. Um, so again, to recap, there are there are a number of things that you can do in order to increase your account size uh, without having to worry about um, certain things such as making your stops too wide, pip wise, or um, things of that nature. Like uh, you can always extrapolate what you're willing to risk over your stop loss. You can extrapolate what your potential gain is of your stop loss, and by using things like um, risk to reward ratios, you always, especially with smaller accounts, you come up with a figure that you're willing to lose. Okay, and you extrapolate that among your stop loss, and you can actually slide and move your stop loss. If you want a tight stop loss because you're going for something that shoots down in one direction, or you've got, like in this situation here, if we were in a downward trend and our swing trade is set up and we know that if we at any point in time come about to this red line, then we're done, then work it out. It's $200 over $30 using that very simple formula I gave you earlier. And and that's actually right about 1 to 3 right here. So if it were to come down, providing this was a real line, if it were to come down to about 100 pips or so, then you stand to make a pretty great deal more money uh, than you would stand to lose in 2 or 3 trades in a row. So I really hope that helps. I really hope this makes a huge difference in your trading. From the beginning, the basics, candle formations, all the way up to utilizing support and resistance, putting everything together, having the ability to do swing trades and breakouts, and last and most importantly, positioning your lot sizes in such a way to where it doesn't um, you don't have to worry about, how many pips am I willing to risk? How many, you always think about it in terms of a dollar amount. Then I really hope this all helps putting everything together. Um, I hope it helps you supplement your trading if you're an existing trader. I hope it gives you a really good foothold to get started if you're brand new.